I think the biggest challenge or the biggest pressure is when you take other people's money, right? You feel
Mm.
responsible, right? So there's added extra pressure on you to make sure whatever deal you're going into with your investors does well, right? The way I handled that is basically explain to them upfront, hey, this is why I like this deal. These are the risks. And I always tell them there is always a chance, like any other investment, you could lose your money, right? If you're having your daughter's wedding next year and you need this money, please don't invest this money.
Hi, Adam Gower here, founder of gowercrowd.com and host of The Allocator, a new way to finance real estate podcast and YouTube show. Welcome to this week's episode. My guest today is Dr. Raj Venkatramani, who is a pediatric oncologist. That's his day job. But in his spare time, he is also a capital allocator, real estate capital allocator, and co-general partner on several deals. He's going to talk about what you're going to learn about today is his background, how he came into real estate, the lessons that he's learned, how he transitioned into capital allocation and into co-GPs, very detailed. Talks about numbers, absolutely fascinating. He explains the good and the bad of the industry. He's very candid, gives some good advice based on his experience and how he manages to fit it all in using automation. It's quite fascinating. If you have not already done so, please go to gowercrowd.com and hit the subscribe button and sign up for my newsletter. It's totally free, comes out once a week, and in it I share tips and tactics for capital raisers and some of the insights based on my extensive lifelong career in investing in commercial real estate. I'm going to be doing some investing myself this year, and I'm sharing how I do it, what I look for. You're welcome to come along for the ride. All there at gowercrowd.com. Just hit the subscribe button. Okay, enough of that. Now it's time for Dr. Raj Venkatramani coming up next. Raj, thanks so much for joining me. Oh my goodness, we've been connected for a couple of months. We've got the conference coming up. Thank you so much for inviting me to that. But today it's all about you. And I notice I'm looking at your website, not at your website, at your LinkedIn profile. I help doctors invest in real estate. Okay, open-ended question. Start off with, how do you do that?
It kind of relates to my own story. So of course I'm a physician, so that's why I'm helping my physician. My customer avatar is physicians. But when I graduated, I've been a physician for some time, and I noticed I save a lot of money, right? I don't spend, I'm an immigrant. And then I noticed that, oh, if I want to retire in 20 years, this doesn't seem to be enough. The other thing which was worrying for me at that point was all my money is in stock market, right? What happens if there's a crash? I don't have any diversification. So I wanted to invest in real estate as a main source is diversification. That's my number one goal is diversification. But I was a very busy doctor then, and my wife was in a different city. She's a doctor too. I had young kids, and doing active real estate was not an option for me at that point, right? So that's when I stumbled across real estate syndications and started investing back. This was back in 2017. And then gradually, every year I've been investing ever since, and gradually learned about how things work and what are the benefits of this kind of investment, both in diversification, tax savings, and also growth of your investment. And in 2021, I decided, okay, not a lot of my colleagues know about this. And I can fill this niche where I can help them, though they are in the same situation I was in 2017, 2016, where they don't have a lot of time, they have high income, and I can serve as a person who shows them how to do this. So that's how I started this company in 2021.
Okay, so what do you actually do then? Let me try and I'm just going to try and guess.
Mhm.
You find sponsors, cut deals with them, bring them outsized checks, and split the delta. Is that it in a
Yes,
nutshell?
well,
Okay,
that's
so give me the
basically
details then, if you
yeah, yeah.
would.
So basically, I'm investing myself in all these deals. I'm bringing into my investors, right? So I'm doing all the work like due diligence. I'm keeping up to date with the real estate network. I'm identifying the sponsors, and I'm doing the background check, making sure they're good operators. And also, I'm keeping abreast of the market, what's happening in the market. And then when I'm going to invest my own money, I'm also bringing my colleagues, my investors along with me to invest in the same deal. So my value add for them is I've done the groundwork for them. I've done the underwrite. I also do the underwriting for these properties when I find the properties from other sponsors. So I do all the groundwork for them, and then we go in together to get a better deal, usually from the main operator or the sponsor.
So describe that to me, will you? So when you say a better deal from the sponsor, just actually give me real numbers. I think that's what people are interested in.
Sure. So, for example, a typical real estate deal, the minimum investment is about $50,000, right? But typically, sponsors have various levels where you can say, hey, if you bring me $500,000, I'm actually going to give you a higher return. If you get me $1 million, because it decreases the work of the sponsor or operator. They don't have to go and find 20 different investors for that money. They don't have to answer to 20 different people. And I serve the investor relations function for them. So we bring in a larger check. So they're able to give us a higher return in exchange for it. So my investors get an opportunity to get the higher returns, even though they're investing a lower amount, because we are going as a group, so we can get a better deal. So that's what we are primarily doing.
Okay, so give me actual numbers though. So 500 to a million, let's say you've got $1 million into a deal. What would that look like on the sponsors? What kind of terms would they offer that you would find attractive?
Sure, yeah. Typically, me and my investors, we are looking for about 15% IRR, because again, it's also depends on what risk and benefit levels, right? Risk benefit ratio you want. And most of myself, including my investors, we are looking for first capital preservation, right? We are not looking for 25% return. Our typical goal is around 15% IRR. And if I invest $50,000, the sponsor is going to give me a 15% IRR, maybe a 6 or 7% pref. But when you go together, maybe you can get a 16% IRR and 7 or 8% pref. So our pref is higher, our total return will be higher through the terms of the deal itself.
Well, hang on a minute. What do you mean they give you a 16%? So you've got a pref. What do you mean they give you a 16 instead of a 15%? Just explain that.
Depending on the class A, B, or C, whatever they call it, the split of profits with the sponsor is actually different. Right? So if you give a higher amount, they may split the profits with you at 80-20 ratio, where 80% of the profits come to you and 20% goes to the sponsor. But if you put a lower amount, they may split the profit in a 70-30 ratio, where 70% goes to you and 30% goes to them. So if you're on a higher level, you're able to negotiate saying, hey, we get more of the profit split at the back end.
And so when you get these splits with sponsors, do you share those pro rata with your investors, or do you harvest that for your compensation, the delta?
So we do it in a couple of ways. So in some of the deals, I'm actually not only investing, I'm actually actively involved in the deal, right? For example, I sign on the loan. I'm actually part of the asset management team. I do investor relations. I do K1s, etc. In those deals, in addition to what I invest along with my group, I'm actually getting a part of the ownership of the apartment complex, where I'm considered as a general partner of the apartment complex, because I'm doing all those functions of a general partner, of course, along with some other operators as well. So for those deals, I get a compensation on the owner side of things. When they do 70-20 or 70-30 or 80-20 or 70-30 split, I'm getting a compensation from the 20% or the 30% where the operator is making. I get a share of that profit. But if I'm not doing those active roles, then we do a fund of fund model where my investors are still getting a higher return, but I also get a part of the return of the top as a compensation for the work I'm doing.
Right, the delta. So if somebody gives you an 8% pref instead of a 6, and an 80-20 instead of a 70-30, you keep the delta in that case.
May not be all the delta. It might be like my investors get 75, and then I keep the 5%. Or if the pref is 8, maybe the investors get 7, where I get the 1% difference.
Okay.
So
and do you
want my investors to make more when it comes to me instead of them going directly to the sponsor.
And do you charge any fees to your investors or to the sponsors?
Again, it depends on the structure. Sometimes we charge a due diligence fee to the sponsors, but not to the investors. Typically, we don't charge any fees for the investors.
And how do you calculate a due diligence fee to sponsors?
Again, it's going to vary based on the actual deal. And it's not a percentage of the raise. It's usually a fixed fee upfront where we negotiate it and saying, hey, I'm doing the underwriting, I'm doing flying to your property, I'm doing all the work there. So I need this amount of due diligence fee to cover the cost for operating for our company, right? So that's what due diligence fee is. Whatever I'm operating, trying to find this property, underwrite, etc., it covers the cost of that.
And you said that when you do co-GPs, sometimes you are on the GP side splitting GP economics. In those cases, typically how many GPs do you see involved in those deals?
So typically 4 or 5. So if there are more than that, I usually don't get involved in those deals because then at that point it doesn't become a co-GP structure. So because
well, what is it if it's not a co-GP? If everyone's like on on the GP, why is it? Why is 5 people coming in that role a GP structure and 10 not?
So by SEC rules and by convention, all of them need to play an active role. Of course, it's a team effort, but each one of them have to have a definite role within the deal. Like, hey, I'm doing the investor relation. This guy is doing the asset management, and this guy is doing a different thing. If you have way too many people, it's very hard to justify that all of them are doing a specific role. At that point, it becomes like a capital raising person or capital allocator is made a GP because they're raising money. So which is a no-no under SEC rules. So you have to do actively, and if you have too many people, it's very hard to justify that everyone is being an active partner in that deal.
And how many deals would you say you are with how many different sponsors are you a co-GP?
So it's the number of sponsors. When I started out, I was involved in different sponsors. To be honest, I partnered with 4 or 5 sponsors. Right now, over time, I restricted myself to 2 of them, right? Because I like them. I like the way they operate. I like the way they manage the properties. I've developed a long-term relationship with them. So as time goes on, I've been restricting my partnerships where I only partner with very small number of selected people rather than partnering with anyone. And that has served me well. So these are not like a very high, well-known people, but these are people who work with me, work with my investors. They'll answer my questions, and I have some influence over what they're doing.
And what's the typical size of a deal? And how much, per deal, what is a kind of a comfortable range for you to raise? And what would be the total size of those deals that you tend to invest in?
So most of our deals have got minimum 100 units. I'm primarily do multifamily properties. So we invest minimum 100 units because economies of scale. Below that, sometimes it doesn't make sense. And then our typical range has been anywhere from 20 to $30 million. We have done like $13 million to like maybe 10 to $30 million is our range of investments. And typically I'm raising about $2 to $3 million per deal.
Hang on a minute. So wait a sec. So so you said it like a $30 million deal. So the raise is going to be what, 12 or so, 10 to 12 million, something like that.
About
And
10 million typically.
and you would typically, your comfort range is $1 million. Is that right?
About $2 million is my mean or well, you can say median is $2 million.
2 million. Okay.
Some deals less, depending on my investor's interest in investing in that deal. Yeah.
And so where does the rest of the money come from?
So when you have 4 or 5 people, the main operator is still raising money, and all the construction guy is raising money, right? So not only they not only serve the operator purpose, they're also raising they have their own investors. So all of us are bringing our own investors and then putting money in the deal. Yeah.
Oh, I see. So each of the GPs, really their primary role is to bring capital, but to satisfy SEC regulations, they also have other roles. Is that a fair way of describing it?
So the way it works is the person who finds the deal, right? Usually is the main operator, but he also brings in money. He's not saying, "Hey, I found the deal. I'm just going to do this," right? It's a team sport. So everyone involved in there tries to get us through the finish line. So yeah, everyone as a GP typically raises money as well, varying degrees, but they not only raise money, but they're also doing other stuff at the same time.
Okay. And you focus only on multifamily, is that right, Raj?
Yes, we have done some strip malls, but our primary focus is multifamily, both new construction and Class A, B multifamily.
Describe your sponsors to me. Like, what is their like? How have you said they're smaller? But what are the characteristics that they have that give you confidence that they know what they're doing?
Sure. So I can describe both of them I work with. One of them has done multiple full cycles, right? So they have gone through and they have gone through the lows and highs of real estate. They also have a strong financial background, so they actually know how to underwrite the property. They also have run big companies before, so they're not like this is their first job. They dealt with people, they manage people, right? So that's an important characteristic to have.
How long have they been in real estate, typically?
So this specific person has been there for about 10 years.
Okay.
Um, Before that, he was a banker and ran a big banking operation. The
Okay.
second person, in contrast, hasn't been in real estate for a long time. He has been in real estate only for 5 years,
Okay.
but he was working for a CRA company for 13 years before that, doing asset management, right?
Okay.
But he didn't have his own deals, but he's deep into real estate, understands the basics of it. So that gives him a specific advantage when compared to anyone else who are just jumping into real estate. So those are the things. Plus, not only that, I typically know these people for at least a couple of years before I partner with them. It's not like I'm talking to them today and then tomorrow we decide to partner, right?
Mm.
Meet them in multiple conferences, have multiple conversations, go on their podcast, talk to their investors, talk to their previous partners, and then look at the specific deals they send. And then eventually, if it meets my buy box, what do they have? That's when we decide to partner.
You mentioned that you do the underwriting. How do you're a doctor. Yeah, what did you say? You're a pediatric oncologist or something. Is that what you said? Right. Okay. So how did you learn how to do real estate underwriting? It's not
Oh,
part
so
of med school, is it?
no, so I basically, when I started this journey, I actually went to a couple of courses, like 2-day, 3-day courses, how to underwrite, right? So the
Mm.
basics is pretty simple. The only thing is underwriting is a dry thing to do, but it's the basic. It's not a complicated math, but it's looking at multiple Excel files and T12s and rent rolls and numbers, etc. But once you do a couple of them, it's not that complicated to do. And main thing I'm doing is not only looking at the underwriting numbers because I'm getting the numbers from the sponsor what they're using, but also trying to see the assumptions they have used in the underwriting, whether it's believable or not, right? The underwriting, you can make any deal look very rosy and say, I'm going to give you 3 times your investment in 5 years. But what is the basic assumptions which have led to that projected returns? So that's what I'm mainly concentrating on. Hey, are they saying, is the rent going to increase 5% every year? That's not going to happen, right? Even if it happens, you should not be underwriting for 5% rent increase every year. Or if the occupancy, they should not say, I'm projecting 98% occupancy from year 3 until I sell the property. Again, that may happen, but that's not how you underwrite the property. So those are the things I am looking for is, hey, how are they underwriting debt structure? Are they putting refinancing and are they boosting the returns based on the refinance at year 3? Or how are they projecting the rent growth? How are they projecting the occupancy level, economic vacancy? So I'm considering all those things. And then what is their expense thing? So they're saying 1% growth in expense. Again, that's not feasible. So those are the things, because sometimes you can play with numbers and make a bad deal look good. So that's what I'm looking for. Mhm.
I see. So typically, so when you say you do the underwriting, are you checking the operator's work product, or are you actually building the spreadsheets and the analysis yourself for the sponsor? Which way
So
around?
well, I do a couple of ways. One is the initial underwriting. I actually hire people who are professionally underwriting stuff. They're doing
Mm.
it every day. So I get the T12 and rent roll from the sponsor and get our guy, who I pay per hour money to underwrite it. I can check that one. I also get the original underwriting from the sponsor and then go through that as well to see how it matches with what my guy has done. I'm not
Mm.
typical. I can, but I don't have the time or inclination to do from like from a blank Excel file. So I let someone else do it and then verify that stuff.
And so you've been with REI Real Estate Investing Doc
Mhm.
Capital, right? Or REI.capital.com.
Mhm.
How long is that? You said that's how long? It's 3 years?
In 2021, yeah.
21. So 3, 4 years. So
Mhm.
you entered the market with how many deals have you invested in this way now?
So as a passive investor, I invested in a lot more deals. As an active investor, I think about eight.
And active, so the distinction being as an allocator
Uh-huh.
versus being as a co-GP. So how many on each of those?
About half and half, I would say. Like allocator is half, and then co-GP is about a half of them. Before that, what I meant is I was investing as a limited partner for about 5 years before I jumped on as an active partner.
Okay.
Um,
So in the one,
Getting
oh,
other
okay.
people's money. Yeah.
Right, with OPM,
Mhm.
exactly. So that's funny actually, because I was on LinkedIn today and I asked somebody, have you ever done this? It's an options trader, I know, who's done amazing well. I said, do you ever do have you ever done OPM? And he wrote back, what's OPM? I think he thought it was a stock symbol or something. OPM, other people's money. So, okay, so using OPM in the RAI doc business over the last
Mhm.
3, 4 years, is that you said half and half as GP and as active? Is that 8 and 8, so 16 deals, or
No, no,
four
no.
and four?
Four and four
Four
about.
and four. And so, how much have you raised total
So far, I raised about $20 million total from all my investors.
from investors? And do you invest in every deal that you raise money for?
Yes. Yeah, that's a basic requirement. Is I need to be comfortable putting my own money in the deal before I ask for people's money, and sometimes it's a minimum amount required. I'm not because since I'm investing in multiple deals, I cannot invest a large amount in each of those deals. Sometimes it's a minimum amount required, but at least I'm putting the minimum amount required for
Ah, I
the
see.
deal. Yeah.
Okay, so that could be, so it's not, you don't
50,000.
invest a percentage of the amount. So on a $2 million deal, you
Yeah, I'm
might
not putting
invest
200,000
50,000.
typically. I probably
Okay.
put $50,000.
Okay, it's not 10%. Okay. Um, right. So, uh, uh, now you're also involved with, oh, actually, I know what I was going to ask you. Sorry, I lost my train of thought. I was there. So you mentioned that you went to conferences and you took training. Which conferences and which training?
So I don't know if I want to tell the actual names, but the
No
first I
problem.
went to was a company called DLP, Direct Lending Partners. It was in Florida. That's the first real estate conference I ever went to. I was actually asked to come there by another doctor. And before I started, I've been talking to various people, and I talked to another doctor who was actively doing thing, and he said, "Oh yeah, you can do it." He reassured me, and then he said, "Hey, come to this conference which is next week. Let's talk about it." Right. So then I had to leave everything, and then put a vacation time at work, and then flew the next week to
Mm,
meet with him and met all the people there. And then I was in one of what do you call as a mastermind groups where there is a guy who is very experienced, teaches you how to do those stuff. And we have weekly calls where we go over deals and stuff. So
mm.
I don't want to name that mastermind, but I was one of those masterminds. I was there for about a year where we did underwriting, learned about different deals and those kinds of stuff.
So, of the deals that you've invested in over the last 3 years, and you came into it right at a kind of an interesting moment, how have they been faring?
There is no sugarcoating it. The year I came in was the peak of
Right.
real estate, right? And I did make some. The first deal I was involved in actually is not doing well because it was a Class C property in Florida, and the deal actually bet the projections we were talking about for rent projections. But as you know, in Florida, suddenly the insurance rate jumped. In 1 year, our insurance rate went from 196,000 to 400,000 in 1 year. So that was not written in the projection. Then the expenses for personnel shot up a lot. And of course, we were in a variable interest rate loan, even though we had a rate cap for 2 years, because traditional teaching is when Fed start raising interest rate, it raises for about 2 years, and then it starts going down, right? So we're calculating that, and then no one expected the interest rate to go from like 0 to 5.5 in such a short time. So all those things together impacted our property. We did a lot to save it, but at the end of the day, we could not generate enough NOI to save the property. So the property was actually taken out of our hands and taken over by another company. It's not completely lost yet. It's on a hope note sale. So we still have equity in the property, but of course, it's not getting the returns we are expecting or we wanted. So after that, quickly, I realized I moved on to Class B. Then the next property was Class A, and then was new construction. I moved up the value chain. We quickly realized that we should not be getting a variable interest rate loan. So all the deals I've done in the last couple of years are fixed rate loans, a lot of them Fannie Mae loans. And then the leverage we've used is much less when compared to what we used in 2021. So typically 65% of loan to value, that's what we're getting right now. So that was a learning experience for me, because at the peak of the market, of course, everyone, if you remember 2021, 2020, early 2022 was gung-ho about multifamily, and then everyone was outbidding each other at that time. Of course, retrospectively, you can comment on what could have happened, but when you're going through it, it's very hard to realize whether you're peak or not. Of course, some people, I'm not saying anyone cannot, some people actually realized it. People have done it for 2-3 decades and they stayed out of it. But I was new then coming into the market. Now I have learned the lesson about that situation. So the deals we do right now are typically cash flowing from day one. If it is a pre-built property, we are not trying to force value and cash flow after a year. It should cash flow from day one, fixed rate loans, and typically A, B class properties, not Class C. So I'm trying to de-risk my investment by doing those criteria. And then the new construction, we are getting fixed rate construction loans and going with established players as well.
So that's a huge leap. I actually started my career in ground up multifamily developments in Southern California. So going from value add to ground up is almost like a different business. How are you managing the learning curve on that?
So this specific, the one person I'm partnering with for new development, the reason I partnered with him in the first place is this guy with a lot of experience. But all our new development is in Sioux Falls, South Dakota, which people don't typically think about as a hottest multifamily market. But his team recognized it ahead of time before everyone got hold of it, because everyone was concentrating on Dallas, Austin, Phoenix, right? Those are the hot market everyone is constructing there. Here, he has a team, the 3 GPs in there. One guy is a third generation construction person who lives in Sioux Falls, right? His family has constructed stuff in Sioux Falls for a long time. The second guy is an architect, again, who lives in Sioux Falls. There are 2 local people. The third guy is my main partner, who is the financial guy who knows how to underwrite stuff. And they had already done, by the time I partnered with them, they already done 3 or 4 deals in Sioux Falls. And they knew the market very well. So this was not their first thing. So before I partnered, I actually went for the inauguration of one of their properties. Like they had built Class A, very nice multifamily property event, which was already like 60% leased on day one, right? So I went and checked them out, talked to the partners, and then I went and checked the actual land they were closing on, the surroundings. There was a Starbucks in front of the land, which is a very great giveaway that it's a good area. And there was a gym, like a national chain gym in front of the land. So yeah, that is actually done very well. So we actually finished the phase 1. We are actually doing the phase 2 right now. Phase 1, we just completed end of December, and we are already like 90% leased. All right. So it's 86 units, 90% leased. So it has been doing so well. We are doing the second phase. So basically, I did the groundwork before partnering. Of course, underwriting is a different ballgame. I had to learn the underwriting for that stuff. But this financial guy, he does so well and explains so well. I was able to understand that stuff.
Um, what are the biggest challenges, Raj, as a capital allocator that you have? What are your biggest challenges? Like my first question, how do you find the time? I mean, you're a full-time physician. I mean, for crying out loud.
I think the biggest challenge or the biggest pressure is when you take other people's money, right? You feel
Mm.
responsible for it, right? So there's added extra pressure on you to make sure whatever deal you're going into with your investors does well, right? The way I handle that is basically explain to them upfront, hey, this is why I like this deal. These are the risks, and I always tell them there is always a chance, like any other investment, you could lose your money, right? If you're having your daughter's wedding next year and you need this money, please don't invest this money. This is long-term growth, 5 years, right? So that's one thing. The second challenge I would say in the last year at least has been that since we are coming off a peak and some investors have lost money, people's trust in the system has gone down. So a lot of people want to invest, they have the money, but they're scared by all the news and everything, right? So that has been a little bit of a challenge in the last year to explain to people why I think this is the right time when everyone is scared, when the market is
Well,
down.
why is it the right time?
So yeah, any time can be right time if you underwrite properly, but especially when people are scared, when the valuations of the multifamily apartments are down, right? You're actually getting a good deal because there's not a lot of people, there's a mad rush of people trying to invest in multifamily. And then we know that the new construction, there was a glut of supply in the market in the last couple of years that's definitely going to decrease this later this year or next year. Because of the high interest rate, people have not been constructing that many new apartment complexes. So I explain all those things and say, hey, this is why we think this specific deal, it's not only market, it's not only macroeconomics, the specific deal has to make sense too. So we say this is why we underwrote it for 7% interest rate for fixed for 5 years. So even if it goes to 6%, we're actually making more money, but at 7%, we're still making money. So those are the things I explain to my investors.
So, of that 20 million that you've raised over the last 3 years, 4 years, what are the typical demographics of your investors?
Almost 95% of them are doctors. And my client avatar is someone like me who is in their 40s. They have a couple of children. They still have some student loan left. They're worried about their retirement, right? They're now thinking about, hey, I had to pay for my child's college. When am I going to retire out of medicine? And they have some burnout factor because they have been a doctor for a couple of 20 years, a couple of decades. And they're trying to say, hey, middle life, should I do something else? So almost all my investors, they connect with me with my story, right? So those are the type of people who invest with me.
Mm. And what have you found is the best way of finding new investors?
My main source of finding investors is LinkedIn, right?
Oh, really?
Yeah, almost exclusively LinkedIn. On the second is referrals, right? People who have invested with me, they refer their friends. So those
Mm.
are the two things. But again, 90% of investors I have never met in person that who have invested with me.
Isn't that incredible? Yeah.
Yeah.
And when you say on LinkedIn, so is this just because you post a lot and they come
So
looking for you, or do you DM them, or like what do you
yeah,
do on
I
LinkedIn?
do a couple of things. I do post my story, and typically, of course, you're a LinkedIn expert, right? So even if they don't comment on your post, if you don't engage, they're actually watching you from afar. Because I have had people who say, I've been watching your post for the last 2 years. Now I want to take the step, right? So you have to be consistent in your posting. I also do direct messaging, like new connections. And I basically, the reason I put in my LinkedIn banner what you said in the beginning is I
Yeah.
want them to know what I'm doing. I don't want to deceive them saying I'm a doctor. First connect and then say, hey, invest with me, right? I want them to know when they connect with me, saying this guy does what he does, right? So that they don't feel like, oh, this guy connected with me because he said he's a doctor. Now he's trying to sell me something. So my profile makes it clear that
Mm.
I'm doing this business, and if they connect with me, that's fine. After that, I send them, hey, I've provided them free value. I send them my ebook, and then say, hey, if you're interested in the ebook, this shows how to invest in real estate. I have a LinkedIn newsletter. I have more than 1,300 subscribers for that newsletter. So then they get this newsletter periodically about real estate investing product value. And when I
Hmm.
do a deal, I put it there, and then people contact me and say, hey, I'm interested, kind of thing.
Well, that's really fascinating. All right, so let's see. All right, so let's start moving towards wrapping up.
Mhm.
But I've got so many questions. Oh, we haven't even talked about the conference, for crying out loud, but we'll get to that in a second. Um, okay, so how there's a lot of allocators out there, as you know, and it's a growing industry. So how do you feel you stand out? How do you stand out from that crowd of allocators? What makes you? Yeah.
So, so I don't think I have to stand out. I'm serving a specific population. I concentrate on that population, and I'm happy with serving that population. I'm not trying to serve everyone, right? For a person, a middle-aged doctor who is going through the things I am going, I'm the best person to understand them. They're always looking for someone who understands their situation and then being honest upfront. For me to run my business, I don't need hundreds of thousands of investors. I need 100 to 200 investors who trust me, and then we benefit together with investing. So that's what I'm trying to do. I'm not trying to capture even 1,000 investors. For me, like 100, 200 active investors who trust me, who works with me, that should be good. So I'm not trying to be, I'm trying to be me and serve them properly, and then people will come once they know the benefit.
Very nice. All right. So I'll tell you what, let's roll into some rapid. Oh, actually, the conference.
Mhm.
So wait a minute. You wear a lot of hats. Not
Mhm.
only are you a pediatric oncologist and real estate investor and general partner, but somehow you're running a conference that you very kindly invited me to. Just tell me about that little side of your life and Avastor and
This
what you
actually
do with all that stuff.
grew organically. So I got into this real estate active investing business, capital allocating stuff. And then I started learning about, hey, marketing, LinkedIn, automations. It grew out of necessity because during the daytime, I'm concentrating on my hospital work, right? 100% committed to it, treating patients. So during that time, I cannot be doing things related to real estate and stuff. So I was forced to come up with automations where I can engage with investors, communication, those kinds of things. So I used tools like Active Campaign initially, the CRM tool, then came across a tool called Go High Level. And I put the systems in place for automations, social media marketing, etc., for my own company. And then one of my friends, who is a doctor as well, who was doing active real estate, said, "Hey, Raj, can you set this up for me as well?" So I set it up for him. That sparked another company. It's called REIDOC Agency. So now I serve about 80 active real estate investors who are part of the company, where I set up the automations for them, manage their backend CRM systems. And doing that, what I found is we are using more and more AI in doing our automations, doing our communication, copies, those kinds of things. Excel. Then I real estate conference. There are a lot of real estate conferences, but nothing concentrating on how AI can be used in real estate. So that's how I came across this idea. And then, of course, I came across a amazing YouTube channel, and I saw what you do. So I said, okay, I should have this person come and talk about AI and how he's using it so that it can benefit other investors. So thank you very much for accepting my invitation.
Incredibly flattered that you asked me. Thank you. So actually, I think our video is something's going on, and we it stuttered a little bit. I'm sure the recording will be perfect. So
Mhm.
let's move to wrapping up.
Mhm.
I've got. I used to have three. Now I've got five final rapid fire questions.
Okay.
Rapid fire questions. So Raj, what would you say has been the hardest lesson you've learned in real estate?
Hardest lesson is trust but verify. Um, Not everyone in real estate is working for the benefit of the investor. So that I learned pretty quickly. It's completely different from medicine. Medicine, we all have the same goal, right? Save the patient. Becomes much easier in medicine because you can have personal conflict, but at the end of the day, patient comes first, always. In real estate, there can be other conflicts. So you got to be trust and but verify. Mhm.
Okay, and actually, it's actually four questions because the
Mhm.
second question you already answered, which was the
Mhm.
best way to find active investors. What do you think? So you work with a lot of allocators. You're quite deeply involved in the industry. What would you say makes for a successful capital allocator in today's environment?
So it's a long-term play, right? So you're trying to build a company. Um, a lot of people, because I serve a lot of clients who actually are new real estate active investors, they don't have the understanding, right? It is a long-term 5-year, 10-year cycle. So you have to be prepared for the long haul. It's not like you start doing this and then next year you're going to be a millionaire. Right? So provide a lot of value consistently and then grow your company slowly. You're going to get there. But it's not like overnight, you're a capital allocator today, tomorrow you're a millionaire. It's going to be slow, steady process, a lot of value add to your investors, then you'll get there.
Um, Penultimate question. So if you could go back in time before you started investing in real estate, particularly the allocator aspect of it, what advice would you give yourself before starting out?
So I would say I could have started earlier in real estate. So that's my advice. Like I started relatively late from my point of view. It's not too late, but relatively late. But I could have started earlier. There are so many opportunities there. I was always afraid of doing active real estate because primarily because I didn't know anything about it. Right? I should have started learning about it earlier. I could have started earlier as well. Yeah.
All right, last question. What's the biggest misconception do you think people have about the capital allocator industry?
So it I don't know if the common people, but the capital allocators themselves have a misconception, I think. Again, goes back to the same thing. One, it's not easy, right? So people think, oh, it's so easy to do it. It's not easy. It requires hard work. It takes time. It's not an overnight stuff. So you have to be prepared to be committed, like any other business. No business is easy. You have to be committed to the thing, and you have to know what you're doing, why you're doing it, and who are you serving, right? So if the primary purpose is to, I'm going to become a millionaire tomorrow, it's most likely is not going to happen. You have to have a mission, serve someone consistent, and then work for the long haul, not for the short term.
Dr. Raj Venkatramani of REIDOC and REI Agency. Thank you so much for joining me today on the podcast and show.
Thanks, Adam, for having me. I really enjoyed participating in this podcast.
All right, that was Dr. Raj Venkatramani. Thank you, Raj, if I may be so informal. What a pleasure having you on the show today and having met you and getting to know you. It's a real treat, and I'm looking forward to the conference. Actually, I'm recording this now. I suspect, unfortunately, that the podcast will actually go live after the conference. But nevertheless, I'm sure we'll have plenty of other opportunities to work together in the future. And thank you to dear viewers for joining me today. I'm sure you found the conversation with Dr. Raj as interesting as I did. I'm very grateful to him for having shared the details that he did. It's very interesting to hear from people who have actually been there and done that. So thank you, everybody, for having joined me today. All right, so that is it for this week's episode. Until next time, this is Adam Gower signing off.